Hello, I'm Alan Kohler, founder of Eureka Report, now part of Intelligent Investor, finance presenter on ABC News and a columnist for The New Daily.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are
The Money Cafe.
And the cafe's empty this morning because we're here really early.
We are, sorry, Alan.
Because of you, because You've got a call at 8 o'clock. Who is it with?
Ryan Stokes of Seven Group.
You're going to ask him about the Four Corners, about Channel 7 on Monday night?
Yeah, have to ask about how he sees that business in the context of that report. I mean, we know the business from their February results has been struggling along a bit. It's pretty tough in media world at the moment as the economy turns down. So this is another problem on top of that.
Yeah, well, it was quite a story, really.
Yeah. I mean, the story from Seven Group is more about Boral, which they privatised in the last half, and how they're going at Westtrack. So they've become a business that churns out pretty impressive numbers, really. But this Seven West Media is, I imagine, a pain in the bum they don't need. Yeah,
but they can't really get rid of it, I guess.
Yeah, that's right. It's hard to get rid of. Who's going to buy it?
What else is coming out today, results-wise?
CBA, Commonwealth Bank, is the big result. So I reckon probably the biggest result of the earnings season. Commonwealth Bank shares are extraordinarily highly valued, both compared to their own history, compared to the big four banks, the other three big banks in Australia, and compared to any bank internationally. You know, we have a talk about the Olympics. We have a gold medal winning bank in terms of valuation.
In fact, it's the most expensive bank in the world, isn't it?
Yep. And it's hard to understand why. Well, it's not hard to understand why. I mean, a high-quality management team, great capital management. You know, you never see CBA issuing shares for dumb reasons or good reasons even. And Australian banks are underpinned by this giant housing market where it's very difficult to lose any money. So that's, in some ways it makes sense, but the valuation's more stretched than it's ever been.
Well, so what's expected out of CBA's results?
Well, I think the profit's going to be touch under $10 billion annually. The numbers don't really matter in a way. They're not going to justify the valuation because the valuation's so high. But the question is, for me, where's this business going to grow in the next 4 or 5 years? The mortgage market's very competitive. Margins may have stabilised a bit, but they're under pressure. AMP has a small bank. Spoke to the CEO, Alexis George, there last week. She's saying we're starting to see ridiculous things come back. The cashback offers are back, for example. So, I guess that's the focus. How does this thing grow? People have bid it up so high. How does it grow? I don't know.
Yeah. And what about the earnings season generally? It's not very old. It's only a few days old. But what do you think was seen so far?
Well, it's the old story of expectations versus reality. And we had JB Hi-Fi on Monday, where everybody expected a pretty bad news story. What they got was a less worse than feared news story, and the stock surged to all-time highs. Now, I don't get that. Sorry, but JB Hi-Fi is about to hit rising unemployment, slowing economy, slowing housing market. They are one of the best group of retailers in the country, maybe even in the Southern Hemisphere, maybe even one of the best retailers in the world, but they're not going to be able to outrun that.
Do you think they'll be allowed to buy ENS trading?
Yes, no problems. They've already got an informal merger clearance from the ACCC.
Right.
Yeah. ENS is a big name down here in Victoria, but I spoke to some people out of state on Monday. Never heard of it. Can you explain to me what this is? And down here in particularly in Melbourne, we're bombarded with ENS ads.
Rob Sinclair,
he's
the family scion who runs the joint, is being kept on as well.
Yeah. I mean, I think this is a little sort of experimental play from JB. They haven't paid that much, $48 million. So I guess they'll see how it goes.
I'm really interested in what's been going on in the market. You know, obviously we had the mayhem of a couple of weeks ago. Big moves. The VIX index of volatility spiked up to 40, which was the highest.
65
at one stage. Yeah, that's right. So, and it was, it's the highest it's been since the pandemic and the GFC.
Yeah, it was an incredible night. Like that Monday night when Wall Street was before Wall Street opened. That was, I did the GFC. That was incredible.
But it's all just as if it's just a memory now. It's amazing. The market's just calmed down. Everyone's just going along.
Yeah.
The VIX index of volatility is back down to 18.
Yep.
It was bumping along at 12, so it's a bit elevated according to to what it was before, but still, it's kind of not volatile at all.
Yeah, and to me, you might disagree with this, Alan. To me, that says this can all happen again. All that bout of volatility we saw can happen again. Now we won't have the yen carry trade blow up because it's blown up, and that can't blow up twice. They reckon, JP Morgan reckons 75% of the carry trade sort of been unwound or washed out. But this is all about the US recession. Now, at the moment, everyone's seeing the data and saying, okay, there's no chance of a US recession. It'll all be good. But everybody is now positioned for perfection. Rates to come down, earnings to go up miraculously. Rates don't come down because the economy's going well. They come down because the economy's slowing. But apparently earnings are going to jump and a soft landing. So if you get anything that tests any of that, then we're going to get this extreme move from one side of the boat to the other.
Yeah.
So I don't think it's necessary.
So there'll be that's right. If there's some evidence that there is a recession happening, bang, it'll happen again.
Yeah,
I mean, at this stage though, it looks like a flu. The market got a flu. Yep. There's a bit of flu in my household at the moment.
Right.
It seems to last about a week.
Yeah, okay.
Everyone's in bed for a week. Market went to bed for a week.
Yeah.
Now it's okay.
I saw an interesting thing. Justin Wolfers, the Australian economist who's based in America, had this interesting New York Times article calling it a toddler tantrum by traders. And I sort of think, I get what he's saying. Everyone got overexcited about this. I guess the other point though is what the traders were worried about is the America going into recession and what that would do for the rest of the world. Like that's a reasonable thing to sort of panic about because nobody is positioned for that.
Yeah.
So anyway, it's been a fascinating period, and I just don't think the concerns that were at the basis of that meltdown, AI, US recession, China, Middle East, none of them for me have particularly gone away.
No, and in fact, as you point out, there's a fundamental kind of mismatch, which is that the market's expecting a lot of rate cuts out of the Fed this year, at least 75 basis points of cuts, which don't happen if the economy is fine.
No. And you'll find plenty of investors whose rule is sell when the first rate cut arrives because the market goes down historically more than 20%. So maybe that won't happen this time. Maybe
this time is different.
Maybe this time is different. But I guess I would just say at least keep it in the back of your mind that it might not be different.
And just before we move on to questions, you wanted to talk about Andrew Hawes's speech, which was interesting.
It was interesting. It was interesting. I mean, he made a speech about overconfidence and central banks. So it's basically saying central banks can't be overconfident at the moment because the data is so muddy and it's difficult to see what's going to happen. And so you should beware of false prophets. And I think we're probably included in that, Alan. Economists, media commentators, various politicians who have certainty about what the RBA should do next. I sort of get the point.
It was interesting. You talked a lot about the weather and the state of origin.
Yeah.
And everyone predicting various things. And
I sort of get the point, but I don't know if you saw the Q&A, but he was talking at one stage about the neutral rate. So this is the rate at which monetary policy is neither contributing or restricting economic activity, and it's like a unicorn. No one quite knows what it is or where it is or how you work it out. And he was saying, and he said at one stage, I'm glad I don't have to invest based on that. But to me, that sort of misses the point. Everyone else does have to invest on it, Andrew. Just because you don't doesn't mean everyone else doesn't.
Sure.
And so investors need to make a call on rate cut scenarios. So I don't think people are being false prophets to annoy the RBA and be backseat drivers. I think they're making calls on rates because they need to. So I thought I got his point about overconfidence. Yeah, of course, the future's inherently unpredictable. Like, thanks. But I just didn't get he said it's a dangerous game that people are talking about where rates go. Like, what's dangerous about it? You're the RBA, just ignore it. So anyway.
Yeah, fair enough. All right, look, before we go to questions, let's have a quick word from our sponsor.
Investing for income is a much-loved part of the Australian investing landscape. Join Nathan Bell, Portfolio Manager of Intelligent Investors Australian Equity Income Fund, for an exclusive live webinar to learn how he invests for income. Discover 5 income stocks superior to the banks and learn why growth stocks are essential for a balanced income portfolio. Register to join live on Thursday the 22nd of August at 10 a.m. or to catch up later with the recording. Plus, all attendees receive Intelligent Investors Income Investing Special Report. Sign up at offer.intelligentinvestor.com.au/INIF.
And since we were just talking about rates, let's go to the last question first, because Matt says, just a correction on your comments on the RBA not raising the cash rate for 2 years based on the Reserve Bank's CPI and unemployment forecasting. Those forecasts by the RBA are made on the assumption of multiple rate cuts, the first being early in 2025. That's true. And I think it's worth just dealing with that because, so I've been saying I don't think rates going to change for a while, possibly through next year. And based on the fact that they're forecasting unemployment of 4.4% through next year, and that's basically what the RBA itself believes to be full employment or close to full employment. So I don't think they'll cut rates if there's full employment. So yes, it is true that that forecast is predicated on there being rate cuts.
Yes.
But what I'm saying is I think that we'll achieve that unemployment. I don't think unemployment's going to go above 4.4.5%. Without the rate cuts.
Yes.
So I'm saying that won't need the rate cuts in order to achieve the RBA's forecasts.
Yeah, and the RBA has said several times that just because it has rate cuts assumed in its guidance or forecasts doesn't mean that it necessarily believes those rate cuts are going to happen. It has to have some direction of rates in those forecasts to make them work, and it uses market pricing. So it's basically taking the market's view on where rates are going. The market's view on where rates is going is being consistently wrong. So
that's right.
Ergo, the forecasts are probably consistently wrong.
Yeah, and the RBA's forecasts for a CPI have been consistently wrong as well. Yeah. So, everyone's wrong.
Yep.
No one knows anything.
Everyone's a false prophet.
Everyone's a false prophet, as Andrew Hawser says.
Yeah, that's right.
Go back to the start. Ben, your turn.
Bert says,
Bert
says, I've been with Hester since 1994 and invested in their ESG type fund way back then. From a values perspective, I've always felt comfortable with them and agree with the principle of having to always have the members' best interest. But I have concerns with Hester investing in social housing and do not think it will necessarily be a profitable investment. Should I move funds, and if so, what are the best options?
Yeah, well, so I haven't spoken to Hester about this, but I have spoken to Paul Schroeder, Australian Super.
Yep.
Who and so it's an investment by Hester and Australian Super into a business called Assemble, which is basically a manager of housing, and it's not social housing really. It's basically just any housing. Affordable. Yeah, affordable housing. It's not. I suppose you can come to what's the definition of affordable versus social. I don't know, but it's definitely a business proposition. It's definitely an investment grade thing. They're not investing for philanthropy reasons. This is not a charity that they're investing in, and they expect a proper return.
Yep.
Like everything, they might be wrong, but that's what they expect. The thing that I was kind of interested in is the proper return for them is sort of 8 or 9% return.
Yeah.
the question, I don't know the answer to this because he wasn't prepared really to talk about it that much, is how do we get 9%? Because the yield on the rental yield on residential property is about 3%.
Yes.
And if that's the case, if they're talking 3%, then that means the capital gain has to be 6%.
Yeah.
And the whole reason we've got unaffordable housing is because the capital gain over the last 20 years has been 6% a year.
Yeah, yeah.
And so if they're assuming a continuation of the 6% a year, that's bad. We don't want that.
Yeah,
right?
I guess so. Not for Bert.
Well, that's right. So when I kind of question all of them about this stuff, they say, oh, well, yes, but what we're assuming is growth in rent. So we're assuming rent, proper rent, but growing rent.
Yeah.
Growing rent with CPI, and
Yes.
that it's a stable asset class that is worth investing in. So anyway,
Yeah.
so
I think Bert says he's close to retirement, so it's more concern of his. I guess the one thing, Bert, is these are pooled investments, right? So Hester's putting some money into this, but it's not going to dominate their portfolio.
No, it's a tiny
by any
amount.
stretch.
In the context of Hester and Australian Super, it's tiny.
So I don't think it calls for you to leave the fund if you're otherwise happy for it.
No, I agree with that.
Yeah.
Vanessa says, I have a question about a car loan. If you were deciding between two loans with 3-year terms at 6% and all other conditions were the same, redraw, ability to pay it back early, etc., would you go fixed or variable?
Variable. Yeah, I mean, unless you think you're Vanessa, unless you think you're good enough to pick whether interest rates are going for the next 3 years, go variable.
Go variable.
And that's the sort of rule, isn't it?
I mean, if anything, interest rates are going to come down over the next 3 years.
Exactly.
So, yeah.
Janelle says, I'd be interested to hear your thoughts on the whole ANZ bond trading scandal. Do you think it will have a big impact on ANZ? Whole story seems a little overblown to me. Firstly, the 10 years future price moved briefly because ANZ's risk manager trading activity. That doesn't immediately equate to market manipulation. Secondly, the AFR's John Shapiro notes ANZ misstated bond turnover reporting to the AFOM. That reporting is not mandatory. It's done on a quid pro quo commercial basis. Lastly, it'd be hypocritical for the government to fine ANZ. The recent cost of living measures manipulated the CPI down through household energy subsidies. So the Albanese government manipulated down interest costs on the $42 billion inflation-linked bond portfolio and everything else pegged to CPI.
Good point.
I feel like this story is going to fizzle out. What do you think?
Oh, it's definitely going to fizzle out, isn't it? I mean,
nope.
It's
will
not
fizzle out.
Oh, right.
No
okay.
way. I mean, ASIC's all over this. I disagree wholeheartedly with Janelle. This is thin edge of the wedge stuff. If you can't trust one of the biggest banks to do the right thing around bond trading for the biggest and most important customer in the country, then there's an issue, a serious issue. So Macquarie has suggested that the fine, if it got to that ANZ would pay is $780 million. That's a fair hit. It's not the end of the world for ANZ. I mean, they're so big. And already ANZ's being, the last 3 government bond issues, ANZ's been overlooked for involvement in that. So there's already revenue leakage. Again, totally minor. But the bigger hit here is if there is found to be wrongdoing, that is going to blow up ANZ's management and board. And again, ANZ won't stop writing loans on the street or whatever it is. But that sort of disruption to a bank sets banks back 3 or 4 years. Don't underestimate how serious this is. If this blows up, ANZ is in a world of pain. They deny everything. They say there's been no malfeasance. They've done their own investigation. We should make that really clear. But ASIC has a very different view. And Joe Longo, the chairman of ASIC, has said we don't investigate unless we think there's a serious breach. And so I think this has got a way to go.
How come Macquarie's suggesting a fine?
Their bank analysts are suggesting a fine.
Oh, I see.
Yeah.
Oh, I see. Right. Okay.
Yeah.
Jesse says, should we give the RBA control of the GST rate? Currently their main tool for managing inflation, interest rates disproportionately impacts mortgage holders while others benefit. According to modern monetary theory, taxes can be a powerful tool to control inflation by reducing demand. wouldn't allowing the RBA to adjust the GST rate provide a more equitable and efficient approach? Yep, the answer is, Jesse, is yes, but it won't happen. Won't happen.
Yeah, no.
I mean, it's absolutely right. But it won't happen.
Yeah. Sorry, Jesse. Sam says, several years ago, I consolidated what I thought were all my superannuation accounts into one. However, it appears I missed an inactive account from 10 years ago that never even showed up in MyGov. My query is, what happens to this lost super, and what are the prospects of anyone trying to recover their lost super so long after the fact?
Yeah.
I mean, I think this should be possible. It's your money, Sam. It's under your name. I don't think this should be impossible. ASIC has a super finder on their website.
But presumably Sam has found that money now and got it, right? He didn't show up in MyGov, but he must now know. He said he missed one, an inactive account, so he's obviously found it.
Yeah. I mean,
I don't know how he found it. He doesn't say.
Yeah, I mean, I'd be talking to the ATO, as Sam himself suggests. I'd be talking to the ATO and ASIC and trying to recover this. My only concern, Alan, is if it was a relatively small account. You know, if you've got 10, you probably worked in multiple places, and whether the fees or the insurance costs have eaten down the balance and there's nothing left because there hasn't been anything going into it. That might be something, but there are super finder tools on ASIC and ATO that I'd be getting into.
Yeah, I know. I think it's outrageous that people, when they change jobs, they get signed up in a different super fund. I think it's just appalling.
Yep.
Angela says, when a company is delisted due to a buyout, e.g. when MYOB delisted after it was bought by KKR in 2019, or the recent Gen X acquisition, I understand that shares are bought out, but what happens to options?
Cancelled.
Yeah.
Yeah, there's no option to do anything, so there's no option.
No, that's right.
Yep. This is from Barbecue Area, which is a great name. Lads, I'm sick of hearing the RBA say that people saved a lot during the pandemic, and this is the main reason for inflation. They also just said in their Senate meeting they can't set policy for one group, but they are setting policy for one group. That group's the group that saved their pandemic money. My question is, why is the RBA allowed to pick and choose their responses that best suit their arguments on interest rates?
Well,
that's what we all do, Barbecue Area.
Mr. Barbecue Area, they're targeting inflation, not the group that caused it. They don't care why inflation was caused, really.
Yeah.
I mean, they look at the numbers. They say inflation's too high. We've got to get it down. The one thing they've got is the sledgehammer called interest rates, and they whack it with the sledgehammer.
Yeah.
And it sort of doesn't matter what it was caused by. And so, I mean...
And I think, to be fair to the RBA, I'm not sure they've blamed people with money for...
No, they certainly haven't.
Inflation.
No,
I mean,
right.
I think what they're trying to say is that inflation's sort of a multi-pronged problem. You've got excess savings from the pandemic, you've got supply chain disruptions, you've got a million things, but to Alan's point, you've only got one tool to try and attack them with. And Barbecue Area is right. They do need the people who are sitting on these excess savings to spend them, to stop spending them. So,
well, they're running out now.
They're running out now, so it's not going to be much of a problem.
The savings are all gone, more or less. I mean, so it's over.
Yeah.
But look, it was an issue. It definitely was an issue, for sure.
Yeah, for sure.
Dean says, Australian Super have reported annualised returns to 30 June 2024. The DIY mix investment options and international shares outperformed the pre-mixed balanced option on a 10-year, 5-year, 3-year and 1-year basis. The cost of product for 1 year is estimated to be $217 for Australian shares, $297 for international shares, compared with $387 for the balanced option. The pre-mixed balance option is therefore between 30 and 78% more expensive than the shares option. If super is about maximising funds available to members in retirement, how does the super fund possibly justify defaulting members into the pre-mixed balance option? I understand there are different risk tolerances for members based on their investment time horizons. However, I think there's a larger point here. What justification do these super funds have in employing large administrative cost centres filled with active investment managers, economists, etc., funded by with compulsory superannuation contributions? Doesn't pass the sniff test for me. Interesting,
yeah. But, I mean, I've sort of been thinking about this. you get what you pay for, right? So the cheapest option is going into Australian shares, and out of the three there, that's obviously the most risky option, because Australian shares is a very narrow area of the investment universe, and Australian returns have tended to lag international returns. So if you wanted to go into that area, you could pay a small fee, but you'll get a worse return based on historicals, based on recent history. You pay a bit more for international shares. Again, equities is the most risky asset class. So you get what you pay for. The balanced option involves running money over lots of different areas of the economy or the investment universe. So Australian shares, international shares, unlisted private equity, unlisted infrastructure, unlisted property, and that costs a bit more, but you get a much more diversified return. So
I suppose our man is complaining about the default idea, that they're defaulting people into the most expensive option. That's what he's complaining about.
Yeah, sure, but I mean,
but it's also the better performing option.
Yeah.
And also I think it's fair to say that if it's balanced, it's probably less risky.
That's right. So I mean, yeah. So I get the point that the management cost is higher. The management cost is still very low relative to most people's super balances, but yeah. I mean, you don't have to be defaulted into that option, but I just don't. Yeah, I'm not sure you can accuse. I don't think there's a rort at the bottom of this that they're trying to make lots of money off.
Andy from Darwin in Dallas.
Yeah, how good's this? Dallas, Texas. I'm a big fan of your work, and I'll make it from Darwin to Leclerc one day. We're in the Short Straw Cafe, so we'll meet you there. I have a question regarding executive remuneration, specifically executives being paid in shares. Are these shares just created when it is time to pay them? Does this not dilute the other shareholders? I understand the incentive behind paying them with shares, but I'm curious to know how these shares come about.
Yes, they issue them.
Yes. And they dilute everyone else.
They dilute everyone else. Correct.
And I guess the company would say, well, that's a small price to pay for making sure our CEO has skin in the game. The other thing that the other way that executives get shares is they get issued options, and they have to pay for the shares at a discounted price. So again, they are created out of thin air, and they do dilute everyone, but at least those ones, the executive has to put some of their own cash on the line.
Nicola says, my name is Nicola, and my question is, the Australian Defence Force has a series of schemes to help serving members own a home. Briefly, they include the DHOAS, subsidised home loans, HPAS, lump sum post-settlement, and HPSEA, reimbursed selling buying costs due to a posting change. This is now being used as a recruitment and retention tool. Service for home ownership. Interesting. I didn't even know that. Is that right? I haven't seen those ads. Whilst acknowledging the slightly dystopian premise, can you see other employers following suit to compete in a tight labour market? Perhaps for harder to recruit industries and trades, like for building AUKUS subs or doctors in regional towns.
Yeah.
Absolutely.
Yeah.
Good idea.
And I think we have seen in the past mining companies particularly wading into property markets in, mining areas. Unfortunately, though, often the mining companies push up the price of that property for everyone else, and it becomes pretty unstable. But I think it's a possible thing. Yeah, there will be some industries where it works.
Yeah.
Mitch has got the question of the podcast, I reckon, here, Alan. When was the last time a government made a tough decision that was unpopular by the majority of Australians, but was of great benefit to the country in the long run? I've been racking my brain about this.
Well,
the GST?
Possibly the GST.
Yeah.
But it's fair to say I think the Labor Party tried to do that in 2016 and 2019, but lost.
Yes.
Capital
gains.
What it tried to reduce the capital gains tax discount from 50 to 25%, and to only allow negative gearing on new homes. And then it also, in 2019, added a crackdown on dividend franking, which arguably was the reason they lost.
Yeah.
But
so
anyway.
It is a good question from Mitch, though.
Yeah.
And we the GST is probably the last moment that sort of stands out to me in a major way.
Yeah. I mean, it's interesting to think back to the Hawke-Keating government and the way they came in and had the Prices and Incomes Accord, which was designed to hold down real wages.
Yeah.
Which it's possibly fair to say no one really got it at the time.
Yeah, yeah.
That's what was going on.
Yeah, whether it was unpopular with a majority of Australians, I don't know.
I don't know either.
It's a good question, but yeah.
Damien says, I've noticed that a lot of the discussion in the Money Cafe centres around politics. How much influence does politics and government policy have on the market? How much influence do you both think it should have? Should all government subsidies and grants be faded out and the market left to fend for itself? Or is government regulation and investment the key to economic stability?
Oh,
that's a big one, Damien.
That's very philosophical.
I'm actually just reading Victor Schwetz's book at the moment.
Oh.
Victor being the Macquarie analyst in New York.
Yeah.
And he's written a book about the history of modern capitalism, basically.
Right.
And he tackles this stuff because, his point is that the whole history of the economy is about this.
Yeah.
About government involvement, whether it's communism, fascism, or democracy.
Yeah.
And democracy is not free market. It never has been. And even the neoliberals want some government involvement in the market.
Yes.
Not zero.
And I think, to summarise some of Victor's arguments, the problems that we've got now around inequality means that we're probably heading towards governments having more control over the economy, not less.
Well, that's right. And Victor says neoliberalism in general is dead.
Yeah.
Or passing phase.
So I don't think it's a question of what we want, Damien. It's more a question of what we're going to get. And it's probably more government intervention in more places. You can see that in the last 5 years.
So the question, I guess, is government regulation and investment the key to economic stability? And the answer is, to some extent, that's true.
Yeah.
You see what happens when the market's left to itself. You get the GFC.
Yeah.
Entirely.
Yeah.
There was not enough regulation.
Yeah, that's true. That's true. Richard says, ETFs are increasing in popularity. My question is, as more money goes into an ETF, don't they just make more units in the fund? In a normal company with supply and demand, with more demand, the share price goes up. But with an ETF, they just make more units. So why are ETFs the flavour of the month? Is it just for the yield and distributions? I own several ETFs and their prices have not risen, as well as the underlying companies that make up the funds.
Yes, well, that's an interesting question because the thing about ETFs is that the price of the units does not reflect the supply and demand of the units, as it does with listed investment companies.
Yeah.
It is true that when people buy more ETF units, they issue them.
Yep.
So the supply is designed to match the demand, but the price tracks the index, whatever the index is that they're following.
Yeah.
So the ASX 200 ETF simply tracks the ASX 200 index, and it rises and falls with that index, not with the supply and demand of the units.
Yes. Which is what it says on the tin, to be fair.
That's right. That's what it says on the tin. That's what it's all about.
Yeah.
But it is true that in an LIC, it does tend to trade at a premium or a discount to the NTA, which is the value of the underlying assets, according to the supply and demand for those particular units.
Yep. Yeah.
Steve says, you are a mature, well-regarded business person. That's obviously talking about you, James.
Yeah, keep going.
In my experience, is in the minority. That is, you are of the opinion that climate change is a significant risk to our economic, let alone social and environmental systems. Would love for you to articulate your thoughts on this and perhaps also why you think so many remain sceptical despite a weight of scientific evidence on what is up ahead.
Steve's a climate consultant, we should say. Alan?
Oh, he is. Yeah, that's right. He's a climate consultant. Well, my view of the matter is that it's largely a matter of risk management, that there's a fair chance that the global temperature is going to rise above what's going to be comfortable.
Yeah.
So, whether it's 1.5 or 2 degrees or 2.5 degrees, I don't know, but above pre-industrial warming. But if all the scientists are saying that, you've got to take it seriously, and so you've got to assume that there's a risk of it at least. And I reckon if I'm standing on the side of the road and I know that there's a 50% chance that I'm going to get killed as I step out onto the road, I'm not going to do it.
Yeah, yeah.
You know, I mean, if there's a 50% chance, or whatever the chance might be, of civilization being in trouble because of climate change, let's do something about it.
Yeah, totally agree. But I think what Steve's also asking is why do so many people remain skeptical? I don't think they remain skeptical about the risk. I think they just think the risk feels like it's so far out in the future and so difficult to abate that it's almost, I think we're seeing more and more companies, investors say, well, what can I really do about this? I'm just not going to worry about it. That is my sense over the last few years when we've seen this. We saw Glencore last week hold on to its coal assets because its investors told the company, we want the money from that coal.
Oh, I think that's rational because coal's going to make money for a while.
But I think that's my point. People aren't worried about their risks because they can't see them occurring for a while, and so they think, I'll worry about it.
But it's also true that those are the people who think there's a risk, but it's a long way off, or that Australia can't do anything about it anyway because we're 1% of the world or something.
Yep.
So there's no point Australia doing anything, which I think is a shocking, point of view. But there's also the thing that the fossil fuel industry managed to turn it into a political issue.
Yes. Yep.
So that the left wing were in favour of doing something about it. The right wing, conservative governments and conservative politicians and people were those who identified in that way.
Yeah.
They were against doing something about it, or they didn't believe in it. Right. So it became a right-left issue, and therefore a whole lot of all the right-wing people said, no, we don't believe in it.
Yeah. Yeah.
We don't think it's true.
Yeah.
And I think we're still in that situation to a large extent.
Yeah.
I mean, there's a lot of people still don't believe in it because it's not hot today. It's cold.
Yeah, that's right. It is one of the great ironies, though, that the sort of bigger the risk, the less you feel able to control it, and so the less sort of attention you pay to it, or not attention, but the less active you are in trying to manage it. I think that's what we're seeing.
I had a very interesting conversation yesterday with a fellow called Raphael Wood, who runs a business consulting on this, but he's also launched a new fund called Silver Capital that BHP, Rio Tinto and Qantas have all invested in. That was announced in the Financial Review on Monday.
Right.
And they've put $80 million into this fund. And what the fund is going to do is develop carbon offsets and what are called Australian Carbon Credit Units, ACCUs, which BHP, Rio Tinto and Qantas will all need in order to meet their obligations to reduce their emissions, because they can't reduce their emissions, so they're going to have to buy these ACCUs. But what's interesting is that the spot price of ACCUs on the market is currently $34.30 per tonne per unit. But what's happening is that we're getting stratification of the market. It's turning into a market like coal, where you get a different price for metallurgical coal as for thermal coal.
Yep.
And it has to do with the integrity of the offsets.
Okay, that's fair enough.
So the basic price of $34.30 is where you don't care where the offsets come from.
Right.
But increasingly, companies are starting to think, I should only buy and I can only buy offsets that actually do reduce or do sequester carbon, right? And it's come about because Santos got sued a couple of years ago in the federal court for greenwashing, right? So it's still in court, right? It's still happening. And in Australia, there are currently 176 court cases against companies for greenwashing.
Wow.
That is to say they're overstating the amount of carbon sequestration or emissions reduction that they're getting involved in.
Right.
And so the activists are taking them to court, right? And what's going on is that the companies have these ESG mission statements, and they're all kind of net zero by 2050 and everything, and they're all kind of promising to be good. But they're getting exposed for not being good, right? So they're all having to say, oh, crikey, we better buy
the real thing.
We better buy proper, and they're having to pay more, right? The point is that they're paying $40 to $50 and sometimes $60 a tonne for proper ACCUs.
That sounds like an entirely rational market response, so that's good.
Yeah, it is good. It's interesting.
There's a note of note of positivity for you, Steve, to finish on.
Okay, thanks for listening, everyone, to today's episode of The Money Cafe. I'll be back next week with Stephen Main. So send in a question and we'll answer it together by emailing themoneycafe@eurekareport.com.au. Until then, I'm Alan Kohler, founder of Eureka Report.
And I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review.
Talk to you next week.